Here is a number I need you to remember: 30%. Most families inherit property believing the process is straightforward. Someone dies, assets transfer, maybe some paperwork, maybe a small tax bill if the estate is large enough. They are wrong. Between state-level death taxes hiding in 17 jurisdictions and a federal reporting requirement that most estate attorneys never mention until it is too late, a $1 million legacy can quietly shrink by $300,000 before the first check is cut. Not because of fraud, not because of bad luck, because of paperwork, deadlines, and a form most people have never heard of. A $1.5 million home in the wrong state can trigger a forced sale. That is not a hypothetical. That is a calendar and a zip code. Before I show you the system, I need to show you something the financial press almost never covers: who built it and whose interests it was built to serve. The term death tax did not come from a grassroots movement of worried farmers. It came from a Republican pollster named Frank Luntz. In the 1990s, Luntz's polling revealed that death tax sparked voter resentment in a way that estate tax simply could not. He embedded the phrase into the GOP's contract with America and recommended in a memo that lawmakers stage press conferences at local mortuaries. His exact words: "Death is something the American people understand." The lobbying group he worked with later boasted in their own materials, "We changed the estate tax to the death tax, and that changed the course of legislative history." It did. The campaign convinced nearly a fifth of Americans that the estate tax would apply to them, when in reality it affected less than 2% of estates. Working people voted to gut a tax they would never pay, on behalf of estates they would never have. The genius was simple: shift the frame from who pays, wealthy estates, to what triggers it, death. Everyone dies, not everyone is wealthy. Once you make it about death instead of wealth, you manufacture a mass constituency for a policy that serves a tiny minority. Keep that in mind as we look at what just happened with the One Big Beautiful Bill. The One Big Beautiful Bill Act, signed July 4th, 2025, raised the federal exemption to $15 million per person, $30 million for married couples, permanently indexed for inflation. People celebrated. Estate planning attorneys sent congratulatory newsletters. Here is what the celebration was really about. The federal estate tax threshold was already $13.99 million. Only 0.1% of estates ever paid it. Raising it to $15 million helped a vanishingly small slice of Americans while giving everyone else the feeling that a victory had been won on their behalf. The state thresholds that actually hit middle-class homeowners: untouched. The reporting rules that trap the Harper family: untouched. The Pennsylvania inheritance tax that starts at $1, untouched. Oregon's exemption frozen at $1 million since 2011, untouched. The Big Beautiful Bill was a significant win for multimillionaire estates, dressed in the language of protecting families. The Luntz Playbook, updated for 2025. When someone dies and leaves you an asset, the IRS resets its cost basis to fair market value on the date of death. Your mother bought a house for $80,000 in 1985. It is worth $600,000 when she dies. Your basis as heir is $600,000. Sell it the next day for $600,000. You owe zero capital gains tax. That appreciation disappears from the tax record entirely. That is a significant benefit. It survived the new law completely intact. But here is where people get hurt. A reporting requirement called the Consistent Basis Rule, IRS Section 1014F, requires the executor to file Form 8971 alongside the estate tax return. Form 8971 locks in the official date of death value of every asset going to every beneficiary. When you later sell that asset, the basis you report cannot exceed what the estate filed. The IRS does not need a human auditor to catch a mismatch. They have an automated matching system that cross-references your personal return against what the estate filed, algorithmically, silently, on its own schedule. The penalty for getting it wrong is 20% of the underpayment. For a gross misstatement, 40%. The algorithm is patient. It does not care that the executor was grieving. It cross-references, flags, and sends the notice. The people it catches are not cheaters. They are the people who simply did not know the system existed. 3 things every heir must do. 1. Get a formal certified appraisal on the date of death. Not informal, certified. 2. Confirm Form 8971 was filed by the executor within 30 days of the estate tax return deadline. 3. Keep the Schedule A the executor is required to give you. That is your legal basis for every calculation on that asset for as long as you own it. 33 states have no estate or inheritance tax, but 17 jurisdictions have thresholds far below the new $15 million federal limit. This is not a rich person problem. It is a homeowner problem. The 30-year campaign using the phrase death tax targeted a federal threshold so high it was already invisible to most Americans. The state thresholds that actually threaten middle-class families got no campaign, no Luntz memo, no mortuary press conferences. Because the families most at risk do not have lobbyists. The families saved by raising the federal threshold do. Oregon, $1 million. The lowest estate tax exemption in the country, unchanged since 2011. A retired nurse who bought a Portland home for $200,000 in 2005 may now have an estate worth $1.4 million. She is not wealthy. Her house simply went up. But in Oregon, she crossed the line, and her children will owe a tax bill before they receive anything. In early 2026, Oregon Senate Bill 1511 proposed raising the filing threshold to $2.5 million. It passed the Senate 22-5. Headlines called it middle-class relief. Then the House Revenue Committee ran out the clock without a vote. The legislature adjourned March 6th. The $1 million threshold is locked in for the rest of 2026. No legislative rescue is coming. Massachusetts, $2 million. A small improvement from the previous $1 million threshold, but still remarkably low. A family home in Newton or Brookline, combined with a retirement account and a modest life insurance policy, easily clears $2 million. Most of those families have no idea they have a state estate tax problem. Washington raised its exemption to $3 million, but simultaneously raised its top rate from 20 to 35%, the highest in the nation. In March 2026, the legislature passed Senate Bill 6347, dropping the rate back to 20%. Governor Ferguson has announced he will sign it. But Senate Bill 6347 applies only to deaths on or after July 1st, 2026. Before that date, 35%. After, 20%. On a $5 million estate, the difference between dying June 30th and July 1st is $750,000. Same person, same assets, different day. Mark July 1st, 2026. New York has an estate tax cliff. Cross the threshold by $1 and the entire exemption disappears. The tax applies not just to the excess, but to everything from $1. Two brothers, both in New York. Brother 1 leaves $7.6 million, tax bill $22,000. Brother 2 leaves $7,717,501, $1 above the cliff, tax bill over $700,000. His estate is $117,000 larger. His tax bill is $680,000 larger. As of March 2026, Mayor Mamdani has circulated a proposal to cut New York's exemption from $7.35 million to $750,000 and raise the top rate to 50%. It has not passed. Governor Hochul did not include it in the budget, but it exists, and it has a sponsor. Watch New York's budget negotiations. Pennsylvania starts at $0, no threshold, no minimum. Children pay 4.5%, siblings pay 12%, friends, unmarried partners, distant relatives, 15%, every dollar, from the first one. Someone leaves $50,000 to a close friend who helped care for them at the end. Before that friend sees $1, Pennsylvania takes $7,500, not because the estate was large, because the friend was not a lineal heir. The same political movement that spent 30 years fighting the federal death tax, a tax on estates above $14 million, has never mounted a serious campaign against a state inheritance tax that starts at $0. That asymmetry tells you whose deaths the campaign was actually about. Maryland has both an estate tax and an inheritance tax, the only state with that distinction. Iowa fully repealed its inheritance tax effective January 2025. Where you die matters as much as how much you have. Let me tell you about the Harper family. The Harpers owned a farm outside Eugene, Oregon since 1982. paid $120,000. By the time the father died in 2023, it had been appraised at $1.4 million. The mother inherited it. Basis stepped up correctly. 2 years later, she passed, leaving the farm to two adult children. By then, $1.5 million. Oregon's exemption is $1 million. The estate owed roughly $48,000 in state taxes. The children had no liquid cash. The estate was almost entirely land. To pay the tax, they had to sell. They sold quickly, under pressure, for $1.4 million. The appraisal had been done informally. Form 8971 had not been filed correctly. When the children reported their basis on the sale, it did not match what the estate filed. The algorithm flagged it. An accuracy-related penalty was assessed on top of the capital gains already owed. The farm, in the family for over 40 years, was gone. The Harper family did not lose their farm because they failed to read the footnotes. They lost it because the people who ran a decades-long campaign about the death tax were talking about a $15 million federal threshold, while the $1 million Oregon threshold that actually destroyed their farm went completely unreformed. Oregon SB 1511 died in committee in March 2026. No mortuary press conferences, no Luntz memos, because the families who would have been saved by that bill do not have lobbyists. Now let me tell you how families that protect their wealth do it. Before the tools, these structures are legal, effective, and require attorneys and CPAs to implement properly. The families who use them successfully are the ones who can afford professional guidance years before anyone dies. The Harper family could not. The retired nurse in Portland could not. The system offers these tools to everyone in theory. In practice, the families most at risk are the least equipped to access them. That is not an accident of complexity. It is the predictable outcome of a system reformed loudly, where it served the wealthy, and left intact where it hits everyone else. The revocable living trust passes assets to beneficiaries entirely outside probate. No court, no public record, no 12 to 18-month wait. It does not reduce estate tax, but it eliminates probate costs of 2 to 4% and preserves privacy. The Irrevocable Life Insurance Trust, ILIT, removes the life insurance death benefit from your taxable estate. A $2 million policy in a state with a $1 million exemption is an immediate problem if owned in your name. An ILIT owns the policy instead. The benefit flows outside your estate, outside probate, and in most cases, income tax-free. Annual gifting. In 2026, you can give any individual up to $19,000 per year with zero tax consequence. A married couple with 3 children and 4 grandchildren can move $266,000 out of their taxable estate every year, $2.6 million over a decade, legally removed from the calculation. One critical sequencing note: placing appreciated property into certain irrevocable trusts during your lifetime eliminates the step-up in basis at death. Move too early and you lose the step-up. Move too late and you face the estate tax. The order matters enormously. This requires a qualified estate attorney and CPA, not an online will. So, what can you actually do about all this? Most financial content stops at protect yourself. That is playing defense inside a rigged game. It is worth doing, but it is not the whole answer. For yourself, tonight, find your state's threshold, not the federal $15 million, your state's number. Add up your home, retirement accounts, and life insurance death benefit. If that number approaches your state's threshold, you have exposure and you need to know it now, not after someone dies. If you are an executor or beneficiary of a recent estate, ask directly whether Form 8971 was filed and whether a certified date of death appraisal exists. If the answer is no or I don't know, call a tax professional immediately. Have the real trust conversation with a qualified estate attorney, not an online will, about your specific assets, state, and family structure. For the system, vote on it locally. State legislatures are far more responsive to constituent pressure than Congress. Oregon's SB 1511 failed in part because nobody outside the state house was paying attention. That is a solvable attention problem. Learn to recognize the language when it is being used. The next time someone says death tax in a political argument, you now know what that phrase is, where it came from, and whose interest it was engineered to serve. Remember, Luntz's playbook only works on people who do not know it is a playbook. Understand the asymmetry is not accidental. The people who benefit from the current system, large estates, wealth management firms, lobbyists, are organized, funded, and permanent. The people who get hurt by Oregon's $1 million threshold are not organized at all. Political outcomes reflect that imbalance. Closing it requires the people who get hurt to know they are getting hurt, and why. This video is part of that, not the whole answer. But the families who protect their wealth intact, financially and politically, are the ones who understood the game being played. Everyone else trusted the headline. The federal limit going to 15 million was real. It was good news for the 0.1% of estates it ever affected. Meanwhile, the state thresholds that hit ordinary homeowners, the reporting rules that trap the Harpers, the Pennsylvania inheritance tax starting at $1, all of it unchanged. The 30% was never hiding in the federal limit. It was hiding in a state threshold that has not moved since 2011. In a form the executor forgot to file. In a calendar date nobody marked. In a Maryland return nobody knew to submit. The footnotes exist because the people who write the headlines benefit from you not reading them. Read the footnotes, know your state, file the forms, have the conversation, and understand what you are navigating because it was designed to be navigated badly.